Thank you, Chairman. Lord Taylor, I'm amazed that you think it's none of your business to say whether large investment banks, banking groups should be broken up. Surely, as the Chairman of the Financial Services Authority, it is very much your business and very important that we know your view of whether our banking groups are too big to fail and whether they should be broken up.
Let me draw a distinction. I think there is an issue of the size of banks and whether they're too big to fail and whether they have a financial stability risk. There is a separate issue about competitive intensity. It was the issue about the intensity of competition, where I was saying that the government has chosen to set up the Vickers Commission, which will look specifically at this, and which I welcome it, and where I've expressed the point of view, I think that I would be perfectly sympathetic to an idea that perhaps a bit more competition might be a good idea, but it's not our core issue because we are not a competition authority. If we go back to financial stability, the issue of how we make banks not too big to fail is not only part of our agenda, it's probably the single most important bit on which I have concentrated my own efforts over the last year.
So should banks be broken up for the
reasons? No, I don't think we need to break them up for dealing with the too big to fail problem. And therefore, because I think we can deal with that through other mechanisms, through the mechanisms of having them have enough capital, through having resolution procedures which enable them to fail in a structured fashion, and, if necessary, and this is going to be the big debate over the next year, through capital surcharges for larger systemically important banks, so that for those we are being even more cautious than we are for smaller banks. And that is a proposal for which we, the UK, have very strongly argued in the Financial Stability Board, and which is now an agreed statement of the Financial Stability Board and the Basel Committee, that large systemically important banks have to have levels of loss absorbency higher than the Basel III standards. So I don't think that the too big to fail agenda necessarily says we've got to take the big banks in the world and break them up. I think we have other mechanisms to achieve that. So I draw a distinction between that and the debate which we're having about consumers and competitive...
I completely disagree with you, because I think that you simply cannot divorce the issue of too big to fail from a regulatory point of view and issues of competition in the banking sector. You said yourself that the big failing, which is attributed to Greenspan, but was a general sense, was that investment banking and banking would look after itself, that the mechanisms were all fine and would all continue to work so long as we left them alone. And that was the big regulatory failure. Now, isn't it the case that all the way through, if you go right back to sort of Adam Smith, a key requirement of capitalism is free entry and free exit of market players? And isn't it the case that over the last 10, 15, 20 years, regulation always trumps competition? So you get into a position where, and it's all tied up with barriers to entry. You said, Hector Sants, that nobody's applying, and you don't really know why nobody's applying. Isn't it because, well, very few new players are applying. Isn't it the case that competition, this whole issue of that the all-powerful regulator and the regulatory powers are stopping new entrants from coming into the marketplace and allowing existing market players to dominate markets and to create barriers to entry precisely that are creating these systemic problems?
Well, no, I don't agree with that. I don't agree that regulation has been important to, has created barriers to entry. I think there are naturally arising barriers to entry which may push these markets naturally towards greater degrees of concentration than we want. But I don't think it's our regulation which has done that. I think what has been the case, and this is a problem that we have got to fix, that where there is a perception that some banks are too big to fail, they might clearly, and this is more to do with corporate customers and institutional investors, have a slight funding advantage because people will deposit money with them at a lower price than they would with smaller banks. That's not the case, of course, in the retail customer level, because deposit insurance tends to sort of even out the playing field for them. But there is a potential competitive advantage of very big banks, and that's why we've got to put a stop to too big to fail through the mechanisms of things like contractually bail-inable debt, resolvability, and higher capital surcharges, which are absolutely, as I say, not just part of the agenda, but probably the single biggest thing for which I've been arguing on an international basis over the last year, and where there is lots more work to be done over the next year. But, for instance, the work on improving resolvability of major banks, which Paul Tucker has led within the Financial Stability Board, I think is a very important way forward. I just don't think we have to take the 100 biggest banks in the world and split them up in order to get round the too big to fail problem. I don't think that's necessary. I think we have other tools to get there.
Okay, so do you then disagree that there is, at the very least, oligopoly-type pricing going on in certain parts of investment banking and wholesale markets? For example, corporate underwriting, corporate advisory. Are you concerned about that? Do you not believe that it is part of a regulator's role to ensure that there is fair pricing in markets?
That is a very good issue, and let me tell you exactly what I believe. First of all, in relation to wholesale markets, our philosophy, and it has been broadly supported, is that you have sophisticated customers and investors who may need protection against market abuse and insider dealing, but who do not need protection in relation to the price at which they buy a particular product. And although we have signalled quite a significant shift to a more interventionist approach in the retail customer side, our approach and that of regulators, and so far I think of governments and committees like yourself, has been to accept that rather free market approach in wholesale markets. And I would be wary of moving away from the idea that a buyer of underwriting services, which is the CFO of a major corporate, needs the same category of price protection as a retail customer.
So you think it's acceptable to have oligopolistic pricing in the wholesale markets but not in the retail
I don't
markets?
think there is oligopolistic pricing in the sense of any collusion. I think what there is naturally arising processes to do with brands and the incentives of the purchasers of these products, which do tend to produce dominant players and high degrees of profitability. I think, however, these are so inherently arising that if you went in and took the investment banks and broke them up, 5 years later they would have congregated again. Well, why is this? It's because the CFO who is purchasing and underwriting a product from a major investment banks, in terms of their personal incentives, their personal self-interest, the benefit to them of negotiating down the underwriting fee is very little, and the disbenefit to them of anything ever going wrong or them being criticised for having gone away from the golden circle of the best brand names is very high. So you have incentive structures which tend to produce dominant players. But in a sense, that's no different from the old adage that nobody got criticised in the 1980s for buying IBM. But
you do accept then that there isn't transparency and that there isn't fair value pricing in the wholesale market.
Oh, I think there's transparency. I think there's transparency. I think these people know exactly what price they're paying. It's just they choose to go to dominant
market value. And don't you accept then that that is one of the reasons why there are barriers to new entry? If you have a market that is artificial, that isn't properly priced and not properly valued, isn't that one of the reasons why you don't have new entrants to that marketplace?
Well, actually,
it's an artificial market.
Actually, the wholesale market of investment bank advice is actually full of boutiques, continually emerging, splitting off from existing banks, and in the advisory side of it is a very open competition market. It's just that there are certain functions within it, in particular underwriting, where because of the naturally arising risk averseness of the purchase of these customers, they tend to go to the dominant players with dominant distribution market share, because those are the ones whom they believe that the thing will go well. So I don't think this is an issue about either collusion or transparency or, in a sense, an artificial market. I think there are some markets, and we have them elsewhere, we can have them in soap powder, etc., where dominant brands tend to arise at a dominant position. I mean, that's how premium brands work.
One last question. Is it not the case then that in order to achieve at least fair pricing of risk within the banking sector, that you need to reach a position where you can allow a bank to fail?
Oh, we need to be able to have all banks fail in a controlled fashion, imposing losses on people above and beyond the equity owners, but in a way which preserves the fundamental functions of the bank, in particular of lending to the real economy. And that is the trick in the too big to fail debate.
Are you there yet?
No, we are not yet there, and that is why that is identified as our most important agenda item at an international level over the next year. That is absolutely the most important agenda item which we have still got to get right.
Sure.
And